like to introduce Mr. Miles, who's our acting superintendent. Began
Officially last Monday.
Okay.
Officially, yes. I was here
So-
prior to that.
Right, so we're all welcoming him aboard.
Thank you. Thank you, Madam Chair.
Dave, would you check the sign in? No. Okay, there's no public comment? Okay, and approval of the meeting minutes. Mrs. Simmons. Mrs. Savage. Do you have any questions or comments on what were in the minutes? Okay, all those in favor?
Aye.
All those opposed? This evening, we have a presentation by BFM and RBC, and I believe Mr. Remington is here. Mr. Zablowski will do an introduction.
Okay. Thank you, Mrs. Hartford. We do have our financial professionals here, Brad Remy from PFM, if you would like to sit, and Lauren Eby from RBC Capital Markets. I've asked them to attend because since last September, when the senior high project was approved, we have incurred some costs. We, for the surveying, for the geothermal, geotechnical testing, several compliance issues, as well as paying for architect. And we have been using our capital projects fund to pay those invoices for the senior high. We have designated each of those expenses as a senior high expense, because when we put the permanent financing in place, and we float a bond issue to pay for the senior high school, the first draw from that, once we obtain the funds, will be to reimburse the capital projects. Now, I brought this up in July because as we approach the end of summer and we keep incurring more costs for the senior high school, the capital project fund is being depleted. And as we get to the end of summer, when we have to start paying for the macadam projects and the roof projects and the other small projects that Paul couldn't update us on, but we'll at the next meeting, we're gonna need some funds. And that's why I've asked Brad and Lauren to be here tonight so that we can start to pursue how we're gonna put the permanent financing in place for the senior high school construction project. So with that said, I'll turn it over to Brad and Lauren.
Great. Well, thanks, it's good to see you all again. I guess the last time I was here was at the Act 34 area about 3 months ago. So it's good to kind of go over the numbers again and so forth. Lauren has some information on the market. I don't know how much you'll want to get into that, but I'm going to get into a little bit on the packet that has the green covered handout on it. And I want to talk a little bit again about what's going on in the market, and as well as how we might think about financing this project when you're ready to go forward with this. The first page, again, it's kind of a quick snapshot of where the municipal market has moved a little bit. And I'm sure you're all very aware that interest rates have gone up, and they've gone up rather dramatically since the Act 34 hearing, and most notably over the last couple of weeks. So it does seem to be a trend as to that rates have gone up. They seem to have stabilized a little bit. I'll get Lauren, that's more of her area of expertise than mine, so I'll let her talk to that just briefly in a little bit. But we do know that is a fact that rates have gone up a smidge, and that's going to impact how we do the financing. Okay. And going to page number 2, in terms of starting the formulation of a financing plan, it's always good to start as to what you currently have in terms of outstanding debt. This page you've seen from me before, and it lists your principal and interest payments on your outstanding debt for each of your bond issues. We also list it by your fiscal year, so you can add it up and total it to the right if you look at the far right columns. The top half of the page shows your principal and interest on a gross basis. That is before you get any plan con reimbursement. Because even though we know plan con is a process that's under much deliberation in Harrisburg, these projects are receiving reimbursement, and we will continue to receive reimbursement on these bond issues that you have a percentage on. The top half is principal and interest on your gross debt, and the bottom nets out any plan contract you receive in the projects. If you look at column 7 up at the top, you'll notice that starting with this current year that we're in now, 13-14, your gross debt is just under $5.5 million in terms of principal and interest, and it drops down, if you see in the 15-16 year, to 5.2, then 4, and then it's about 2.2 million for the, what's that, about 10 more years until 2025, 2026 year. So that's what you're facing right now as a starting point before you do anything else for this project. Page number 3, and this is turned landscape. This is what we call as a draw schedule. We actually got this from some information from the lot. It might be a little old, it's from February, but it's the latest we have in terms of how. Sure.
Debt service requirements, local effort requirements. What's the difference?
The debt service requirements is the amount of money, principal and interest, that's owed to the bondholders. That's how much gross they would have to pay out to satisfy the bondholders. The local, what that debt does is it nets out, once he pays the bonds, the principal interest on bonds, he then files with the state for reimbursement through the plan process. And he'll get money back. And what that does is so for example.
That's lower. Okay.
Yeah.
That's why I didn't understand.
Yeah, sorry about that. So right now, we get around $850,000 in reimbursement on plan on your existing debt. Sorry about that. Okay, so page number 3, as I mentioned before, this was a draw schedule we obtained from EI in February, and it talks about how they project the monies to be spent on the project. That's in column number 3, labeled high school project. It's around $45 million is the construction piece. And then over to the right, it says fees, soft costs, fixtures and equipment, some other costs that they anticipate occurring over the next couple of years for the project. And if you look to the right of that, and we bolded it, and it says reimbursed design fees, and that's around 2.7 million is the number that we had heard, some of the preliminary things that David mentioned earlier that the capital projects fund is funding. And those are the dollars that I believe he's referring to when he said we need to reimburse ourselves. So somewhere in the neighborhood, I don't know if that's the exact right.
That's a little higher than where we're at currently.
Where we currently are, okay. But that was some number that they thought would be kind of carried through the summer and fall, I believe. So then what we did was we worked on the right-hand side of the sheet, it says sources, and we figured or tried to determine or look at how you might want to fund the project, okay? And what we did is we thought about, because you're going to need to help use some of this cash that's going to go back to the debt service and capital projects account to phase your debt payments through these next couple of years. And I'll get to a schedule that shows you a little bit better. We wanted to maybe take this down in a couple different pieces. We could borrow it all up front if you want, but we kind of thought that it might make sense to do some now and some later for various reasons. Again, we're going to need that money the more we borrow, the more capital project fund will need, Dave, to help phase us through that period. As you probably are all well, if you borrow the money today, even though rates are still, even though we've seen a little uptick, rates are still good. But even if you borrow it at 4 or 5%, you're certainly not going to reinvest it at that rate. So by putting the money in the bank and having it sit there for a year or so, it's going to create what we call negative arbitrage. And that is you're going to borrow 4.5 or so, 4.5. You're going to reinvest it 0.25%. So there's what we call a negative drag on that money. So we want to keep that in mind as well. The other thing was we wanted to make sure that as you go through the project, we don't overborrow or underborrow. So if you decided to borrow all the money right up front and you didn't need it that much or you needed more, then we'd have to fine tune another financing that we didn't anticipate. So it would be nice to kind of plot it out and make sure, as time goes on, think about maybe doing it in a couple different chunks. And again, also helps you with your budgetary component. So what we were looking at here is something like 30 million here later this fall, and the balance, which is anticipated now, around 25 million next fall. And all these figures are based on what I used, again, was the draw schedule from EI in February, and the 55 million of total project cost from the Act 34 hearing. That was what we did this based off of, okay? And it accomplishes, as Dave mentioned, accomplishes what you want to do in terms of reimbursing your capital project funds.
Right.
Yes, sir.
The $30 million
Yes.
when we float that bond, we get that money immediately. We can't take it out in, like a home equity loan.
Well, on a bond deal, you get it at closing. On a bond issue, you get it all at closing.
Okay.
And, you know, that's a good question, though, because some of our clients that are doing what we'll call smaller projects, they do it like that, go to a bank and, you know, get it as a drawdown line of credit, and they draw it as they need it. But usually those are done for smaller projects, to be honest with you. Yeah, it's tough to find a bank to give you a decent rate, and they're certainly not gonna give you a fixed rate of interest. I think the board would probably be interested in fixed rate. You know, we don't wanna get into the derivatives and things like that. We wanna do pretty much straight, plain vanilla fixed rate bonds, I think, for this side of
The
the
reason for my
project.
question is, we don't need the 30 million immediately because we're gonna make payments to the contractors over the years.
Mhm.
I'm trying to find a way to take what we owe to the contracts out of that 30 million and draw it down slowly.
Right.
But, okay.
Well, that's what we tried to, if you were to go back to under the uses column, and the red numbers bracketed, you can see basically what Eli was saying, here's what they anticipate, how you're gonna spend it. We don't wanna do a financing every month, that would be cumbersome, costly, things like that. So
Yeah,
we're
okay.
kinda, you know, we're kind of trying to balance that out, and make sure that we don't, you know, borrow the money that we don't need to, and we don't do too many financings and things like that, so. That was kind of the thought, at least at this point. So what we did on the next page is, we looked at a couple different options, because we always like to give you options. And that is, we looked at what a payout schedule might look like. And we're being a little bit conservative with the interest rates, don't get me wrong, we're trying to, you know, be a little bit for planning purposes. What it would look like if you go to this page 4, in the blue, and that was if you borrowed all 55 million at first. That's kind of a base case of how that, you could possibly do that. And if you look at under the blue shaded column, actually the number listed, number 6. And what that would do would be, look at what a new payout schedule, principal and interest might be on a new bond issue, okay, over time. And that's column 6. Now, I will tell you on this, we've assumed that you get your plan con money. You know, you filed everything by October 1st, 2012. We do know there was another moratorium put on, I think this is the 3rd year in a row, there was a moratorium on plan con. We're certainly hopeful, although we have no control, nor do I think you, on whether the plan con program continues in place or when it's funded or what have you. But we are counting on that, you know, that you get that plan con money as you go through this process.
So my question on the plan con money is, when in your spreadsheet here, what year or month did you figure we would get that?
We assumed you got it, because what happens is once they approve it, now Dave would have to cash flow it until you got your H approval. But once you get your H approval, you can go back and retroactively get all your reimbursement, okay, from the beginning of the payment schedule. So we've assumed that you get all that retroactive reimbursement. So right now, for example, there would be, could be a couple $100,000 that Dave would have to cash flow through until you got the reimbursement. This, to answer your question directly, this assumes you get reimbursement right away.
And how it worked, Mr. Alcier, is we would make that first payment of, say, in the blue, $1,055,000. That's probably $1.2 million. We would make that payment, principal and interest. We would fill out Form PD 2071, submit it to the Pennsylvania Department of Education. They would process that for rental reimbursement, and the next month we would receive their percentage or their share of the debt and principal payment for that payment. So it'd be about, I think for this project, we're looking about 17 to 20%.
And my purpose in asking this is, my understanding is nobody's getting reimbursed that quick, or maybe I'm misinformed. So, knowing that, I mean, I appreciate you doing this, but I think it's flawed. I think we should anticipate that the reimbursement might be a year away, or 2 years away, or whatever. I mean, I'd rather be conservative that way, if we're gonna plan it out, than plan, you know, than estimate through your spreadsheet that we're gonna get reimbursement like right away. because that ain't happening.
And
So
we-
why would we plan that?
Right, when I run the numbers and so forth, so I mean, I have a good idea on the gross debt service payment, what you're gonna be going up to. And looking at, as we go through, that hard period, if you look at column 5 in the black, you see that by starting the 13, 14 years, again, I carried over where your heavier payments are through 2017, 16, 17, and then it drops down. And it looked to me like, on a gross basis, for capital projects, we need about $3 million or so to carry us through to that period on a gross basis. Okay? I looked at that at the Act 34, I also did it again tonight, just double checking. So that's about what you would need, assuming you've got no other, what's in the budget now, and you didn't do any other source of revenue for that, something like that. Okay? So, yeah, we basically assume that you get the reimbursement.
Well, I mean, I have faith that the reimbursement will be there. I have faith. The question is when.
Right.
So I would question anticipating immediate reimbursement. I think the smarter way to plan it out would be to assume that we may have to go a year or two or whatever before any of that reimbursement starts coming our way.
And that's another reason why you might lean towards the option 2, where you don't borrow all the money up front, you don't have to count on it as coming as quickly.
Okay. And that's in the green?
That's correct. Green and purple.
And purple.
The green is $30 million assumed this fall, and then some estimate of about 25 next year, for 55 million for right number to get the final financing from the bids come in and so forth.
Does that also anticipate plan com reimbursement and then
It does.
payback?
Yep, it does. And the way, again, that would work is, that, again, if David paid it, the gross debt service payment, then you get reimbursed payment based on that, when you get your approval, and you go retroactive and get it back. So we would need to cash flow ourselves through that period of time.
I mean, budgetarily, it wouldn't have an effect, because we would book that as a receivable due from the state sometime in the future, but from a cash flow standpoint, that's something we would have to put in our money.
So,
Right.
yeah.
And I think that's part of the other reason, I think that it's kind of on Dave's mind to get reimbursed for all these costs that you've incurred right now for the project. You gotta get that back in that account, so you can do things like cash flow yourself until you get your plan con, and cash flow yourself until you get to your debt dropping down a little bit. That seems to be important.
I guess the question I have, is right now, there's like, it's been 2 years for people that have completed projects and they still don't have reimbursement. So, there's like 350 projects right now that haven't even been approved for reimbursement at various stages. And we're like, in that process also. But
True.
I'm just thinking that we sort of need to take that into consideration pretty heavily.
What would our option be?
Our option, I guess, is the way we're looking at funding it, not in, from this standpoint here, the way you're looking at getting the funding and what's due out. You're gonna get the money, you have to pay out on your debt service, et cetera. If there's a different way to approach it, where you're not looking at immediate reimbursement.
I think the schedules assume the reimbursement, but I think maybe it's a flawed explanation that I've given, but you have enough cash, it's gonna be about $3 million to get you through until your debt drops down. Okay, right now, I believe your budget, what was it, that's like $6 million or something for debt service, $6.4 million for debt service. So even if you got no reimbursement on this project, if you decided to borrow the money, plan on went away.
Right.
We've tried to structure this such that, while we want the reimbursement, the amount of money that's in your budget now, plus maybe a little bit more, I don't know what Dave's plan is in terms of, projections and so forth, that once we get through that 2016, 2017 year, when your debt service drops down, you will not have a debt payment higher than what you have currently budgeted for. Does that make sense?
Yeah.
Now, what that could, I know you have other things that you're considering, and it could impact other things that you're considering in the future. But I've tried to structure this such that get us through the tough 4 years with cash, with your capital projects fund, self-capitalized interest, cash flow to reimbursement. But once 2017-18 hits, your debt service will not be higher than what you have in the budget right now.
So it'll be two tough years of cash flow.
Yeah.
Right.
But after 2017, we will have the financial wherewithal to handle not getting reimbursed if it takes longer for the state to pick up their share.
Right. Because if, and this is gonna be a little bit dangerous on me doing it, but I'll do it anyway. If you were to go to page number 2, I'm gonna try and do a dip down and dirty, and you were to look at the top half of the page, okay, gross debt service. It's in the fiscal year 17-18, it's about $2.2 million, $2,276,000, you see that? And let's go, for example, to page, so just keep that in mind. If you go to page number 5, page number 5 assumes you do the whole financing now, okay, that's kind of the high end. But if you look in 17-18, in column number 6, okay, you see, if you can somehow work your way down to the 17-18 year, it's a debt payment of about $3,294,000. So $2,200,000 plus $3,294,000 is under $6.4 million. That's a little bit of a dangerous math exercise for me to do on the fly. But my point is, that assumes no reimbursement. So that wouldn't be good, obviously. But if you cash flow yourself through 16, 17, the plan wants to put up, you would not have a debt payment after these tough 4 years that will be greater than what you have in your budget today. So we've thought about that. We want Plan Con because on this Schedule 5, that could be $600,000, $700,000, which I think is helpful for you, not only from a general budgeting standpoint, you want the reimbursement, but it might be more helpful to you as you go through your full capital plan. You follow what I'm saying? But this project in itself would not put you in a situation where you would, in 5 years before, could say, oh my gosh, your debt payment is $1 million, it's not that.
And in 26, 27, it goes up to 4.2 million.
Thank you, because what happens, and it goes up to 4.2, but if you go back to my page number 2, in 26, 27, your debt payment on your existing debt is 0.
And that's that scoop loan that we've been talking about. We're gonna fill in when our current debt totally disappears, the 2013 and the 2014 issue will fill in the gaps that are left.
So your old, in 26, 25, 26, your old debt goes to 0, right? And then the new debt goes to 4.2, which is still less than 6.4, that I think that's right.
Question.
Sure.
Option 1, the local effort is $124,301,000. Option 2, $123,269,000. About $1 million less expensive. Does that take into consideration the cost of floating a second bond?
Yes, sir. It does. And what the $1 million difference is the fact that you're not paying interest on the $25 million for that extra year. But it does make the assumption that in 2014, interest rates are about today what they are, they're then about what they are today. It assumes rates stay the same.
Okay, but there's a cost that goes with floating a bond, all right?
Right.
And that's substantial.
Most of the costs are associated with the size of the bond issue.
Mhm.
Most of them are associated with the size of the bond, the percentage of the bond. So whether you do 30 million or 20, or 30 million or 55 million, it's normally a percentage or pretty close to a percentage of the bond issue size. So let's just say a $30 million bond issue costs you $600,000. A $55 million bond issue might cost you $1 million. Those numbers aren't right.
Okay, all right.
Those aren't
Then you still have the legal.
right. Some of those things are duplicated. Some of those things are duplicated, but normally, to be honest with you, when you look at a $55 million bond, the legal fees are typically a little bit higher than a $30 million bond.
So in your vast knowledge and experience, how much more do you estimate, nothing in writing,
Right.
it would cost to do the two rather than the one? Based on the fact that we're saving $1 million by doing the two,
Probably close to $50,000, something.
it would cost us,
Like a $50,000.
Less?
$50,000 more to do two.
okay, but we're saving $1 million, so it would still be cheaper to do the two. And we can't do the two at one time and just give different dates now?
You're probably gonna need to do two different issuances.
Okay, and
You
there's no
can-
restrictions or anything about doing it that way, that we find out later on?
No, and if you tried to do two at one time, you wouldn't realize that $1 million savings.
Oh, okay.
Yeah, the benefit of separating them is that by waiting that year, that extra year, you're not paying the additional interest on the $25 million that you plan to borrow next year. That's where that cash flow savings
Yeah,
comes
that's
from.
kind of what the cost was kind of, I think, trying to get at, but, don't pay all the interest on the money up once. Yeah.
So even if the state doesn't reimburse us for 5 years, which is likely to happen, we're still okay?
Mhm.
All right, thank you.
Yeah, we did factor all that. I mean, when we structured this, I had in the back of my mind, if something happened on Plancon.
So we just struggled for 3 years.
We would have to cash flow for 3 years, right? And I think and that's why we need to get the money back, I think, from what you're spending on that for design.
David has some tucked away in
Mr. Alsou?
So just to clarify, is it 2 years or 3 years? I heard 2 years, now I'm hearing 3. It's 2016 and 2017 would be the tough cash flow years, is that what I understand?
I think it's 14, 15,
15, 16.
So,
15, 16, 16, 17. This year, we're fine. This year, we're fine.
okay.
If I do my math right. 'Cause I think you have to-
And we haven't borrowed the money, we'll probably make a very small interest payment probably in the spring if we do borrow the money.
So I think and I think it's, it's the next budget year, you'll have to dip, if you want to keep your debt service line item close to this, I don't know what how you're projecting, and how you're gonna do your budget, if you're gonna do some more, increase the line item in the debt service next year. But whatever the difference is, we'll fund with capital projects.
Right, and that's that tenth of a mil we talked about during the budget year, which is gonna happen in the 13, 14, 15, 16. That's gonna help alleviate some of that cash flow.
Right.
And we're talking 3 million is what we need to cash flow.
It might,
Is that what I'm
that
hearing?
assumed you didn't do any of that, I didn't know that was, I mean, if you do what Dave's describing, it's not that much, you don't even need that much. Assuming rates don't, we lock up some rates.
So my estimate is gonna be about 600,000 less, so we'd have to cash flow 2.4 million through those 3 years to make the debt service without having the state assist us in any way.
14, 15.
Question for Dave. The money that you're borrowing, that you're gonna put money back in capital projects that you're using to the dollar?
Mhm.
And what do we have in agriculture committee reserve?
Under community reserve, about 7 million.
So that we're okay, I mean, if things don't work out the way.
Right, we have that, plus we also have the Gilbertsville Fund, which is the grandfathered bond pool that we have.
Yeah.
We also have the debt service fund, which is the money we recoup from the litigation with Mr. Bradbury,
Yeah.
that Mr. Sultanic has told us we can only use for building improvements. So those are two other sources we
Yeah,
can use.
so we do have some backup.
Since there's a minor increase in the size in financing, why don't we go for a whole bunch of $10 million bonds?
That's a really good question. The only thing I'm worried about is if you go back to my draw schedule on page 3, I'm not sure I get the money in time to meet all the draws. If you follow on, if you look at the estimated draw schedule from the architect, if we did 10 million, are you talking about 10 million by calendar year, or? I don't think.
Well, I'm just saying, you know, some,
Right.
we could do that. I'm not worried about the money that's, we pay a 0.25% on, and we get 0.3% when we bank it.
Right, and that's a good point. The only, what I want to try and do is I want to balance what was mentioned before about closing costs. Because if you do 2, then it's up 50, but then if you do 5 or 6 of them, then you're up 300.
Okay,
So
all right.
we're kind of balancing all that out in terms of, there is a good, there's a good possibility, or there could be a potential that maybe we decide at the end of this year, not do 30, but do 10. We'll just do 10, and then do another piece in the early part of 2014, and then maybe do a little bit in 15. That's a possibility as well. But I want to balance out, I don't want to pay too much in fees and closing costs, or have to pay too much. There's always that kind of balancing act.
You feel though that interest rates will be going up now?
They have gone up pretty
Yeah,
substantially.
So a good segue into this. Now, I'm not predicting into the future on these, unfortunately. If I had the ability to do that with any success, I would probably be sitting on the beach somewhere right now. But I'll just briefly go over this packet that's in front of you. I know this was sent to you last week in draft form, but there have been some changes in the market since then. So I did bring an updated one, which I think you all have in front of you in hard copy format. So I will just breeze over most of this. If you have questions after I'm done, or if you want to read this in more detail later and you have questions, feel free to contact us at any point. But it's been a very interesting few weeks in the municipal market, and I think Brad and I are both glad that we weren't trying to market the district's bonds within the last month, because it would have been a very trying task, as we've both experienced with our clients here in the last few weeks, that we're actually trying to market some bonds. The first page is just a real, I'll briefly mention this. Municipal bond funds are one of the biggest buyers of municipal debt. They are the people that are buying, and they're in the market day to day buying new bond issues, such as Boyertown Area School District. This chart shows municipal bond flows, which means the money going into funds and the money coming out of funds. If the number, so if the bar chart is above the line, that's money coming in. If it's below, it's money going out. If there's money going out of bond funds, that means bond funds aren't buying. In fact, they're selling. And if the biggest buyer of municipal debt is not buying new bonds, that means the cost to you to find a buyer that is willing to take on your bonds at that rate, you have to pay a premium to find someone that'll buy it. So this is something that we monitor pretty daily, or whenever we're in the market, because we want to know what are these big buyers of bonds doing right now. And if you look at the far right of that chart, and you see the blown up version to the right, May into June was a very heavy time of bond fund outflows. And if you look at the one bullet point that has a hash mark in front of it, it says last week's outflows were the largest in recorded history, and were 500 million greater than the next highest period of outflows, which was back in January of 2011. That big chunk in 2011 of outflows was kind of in the height of the crisis when Meredith Whitney, who was the woman that called the real estate and the subprime mortgage crisis that sort of caused the economic downturn of late 2008, early 2009. She also predicted that municipal bonds were going to default to the tune of billions of dollars. Well, that didn't really happen, but it caused a whole lot of market turmoil. Saw a whole lot of bond outflows then. It's happening again. And the reason for that is mostly a lot of uncertainty. The Fed came out a few weeks ago and made some remarks that kind of caused a whole lot of market turmoil. I'll get into that a little bit later, but that is just a brief overview of why bond fund flows are important to you here in Boyertown. And the next page is, talks a little bit about what our benchmarks in the muni industry, and you might hear us talk from time to time about MMB. And these are numbers that are published daily that represent kind of what the market thinks a AAA, so the highest rated bond is going to trade at in a primary issue market. I want you to look at the bottom sections, those two graphs or two charts at the bottom, because they kind of do a good job of highlighting what we've done in rates in the last 5-year, 6-year period and then year to date. On the right side, if you see the current row, that's where we are currently. So the 10-year spot on the MMB curve is a 271, the 20 years of 369, and 30 years of 396. That means for, that would be a AAA bond. So the district is not a AAA, but you're close to it. So your bonds would trade at a spread slightly above that. But for comparison purposes, if you look over on the minimum, okay, if you see on January 1st to 2013 to present, the minimum amount of those is 165, 235, and 269. That means the current today versus the minimum this year, which happened not that long ago, early May, so 2 months ago. We are about a point to a point and a quarter higher in rates. This is the largest, biggest shift that we've seen since 1987, I believe. Huge increase in rates. Something I haven't seen in my career, and something Brad, he's only been in a couple of years longer than I have, he probably hasn't seen a whole lot of either. So be glad that during this time we weren't trying to market the bonds, because from day to day, every day, rates were increasing. Finding buyers was almost impossible, because if you were a buyer of bonds, why would you buy a bond today when tomorrow you could probably get 25, 30 basis points higher in yield back to you as an investor? So with all of that uncertainty, it was very difficult to get deals done. We have seen some stabilization within the last week and a half, and rates, while they are continuing to increase, they aren't increasing with the same magnitude that they were for about a week period back in July, or back in late June. So we hope for some continued stabilization, and people will continue to keep an ear to the market and listen to what the Fed says, because they seem to be the driving force right now behind all of this, because they have made some comments, and if you look on the next couple pages, this takes you through week by week and then almost day by day what has happened and why rates have done what they have done. And I won't go through at every point and hash it all out, but I want you to look at June 19th. And on June 19th is when Ben Bernanke came out and hinted that the Fed might start tapering their bond buyback program. And when people heard that, they thought, oh, well, the economy must be getting better if they're going to do that, and rates are going to go up. So I'm going to stay on the sideline. I'm not going to buy new debt because rates are going to go up, and I'm going to hold my money for now. That kind of caused this massive slide up in rates that we saw. From there on out, then, we've seen just some really huge increases. If you look at June 26th, then, however, was when we kind of started to see things come back to earth a little bit. And we all of a sudden had a big swing, and rates were improved by 12 to 18 basis points. And that's something we don't see often either. Usually the increases and the decreases in that MMD curve are in the 2 to 5. And all of a sudden we were seeing 30 basis points worse, and the next day we were seeing 12 basis points better. And there's all this whipsawing going around, and that is not a stable market to price in, and nobody wants to really take a position when things like that are going on. So I'll let you read through this if you want, and if you have any questions now, you can certainly ask them. If you have any questions afterward, you can certainly email Brad or myself, and we'd be happy to talk to you about them. But these are the things that, this is what you hire us to do, is to pay attention to these factors. We have an ear to the market, and we can be in contact with you once we get closer to pricing to say, hey, markets have stabilized a bit, we think now would be a good time to go, and that's why we usually tend to do the parameters resolutions, which allow us the flexibility to market the bonds at a time when there is a little more stability, there might not be as much supply in the market, so your paper will get more attention from potential investors.
But if you go back and look at rates for the last 10 years, I mean, we were at the bottom of the bottom.
That's true.
And, you know, through the spring. you were to look at rates over the last 10 years, we're still below where the average has been for the last 10 years.
That's a
So
great
while
point,
we've
Brad.
seen some, quirkiness, we'll call it, over the last couple of weeks, that we're still in a pretty good rate environment. But we want to be careful to answer your question directly, not to let this get away from us. We probably should think about, for a lot of reasons, planning and so forth, locking something up for the calendar year terms.
Yeah, if you look back at page 2, that's a good point. I did spend a good amount of time catastrophizing there. But if you look at page 2 on the left side, you will see that the general trend of the past 6 years is downward. And if you look at that summary table at the bottom, the current rates, they are comfortably between, if not closer to the bottom of the minimum rates that are listed right above that. So, yes, they have spiked up a point, but they are still at fairly attractive levels. I mean, a 30-year bond is currently a AAA at 396. And if you look back to 1988, that looks like a heck of a deal. So, in perspective, yes, but we will hope for some continued stability as we march forward to a possible fall pricing of your first deal.
I thought we used to be AAA rated, what happened?
Good question. We have, back, we used to pay for bond insurance. When you paid a bond insurance company, you got a AAA rating on your bonds. So the school district wasn't rated AAA, but the bonds were rated AAA.
Okay.
The school district right now is rated AA.
Why?
Okay? That's a very good credit rating.
Well, I thought we were AAA.
The bonds were rated AAA because we bought an insurance policy from a company that was rated AAA.
So now we're not gonna buy insurance.
Well, there's no insurance companies out there that are rated AAA anymore. They all kind of vanished with the financial crisis 3, 4, 5 years ago. The best bond insurer right now in the market is rated AA, which is what you're rated. So why we're not going to pay for an insurance policy when they don't add anything to our bond issue. There's no benefit to it.
So it's nothing we did or messed up
No,
on.
nothing you did at all. Actually, you're doing quite well as a AA. You're doing very well as a AA. I would say if you drew the line in the sand at AA, there's 50 to 75 school districts in the Commonwealth that are rated that
Out
well.
of the 500,
You guys are pretty good.
I wanna be terrific.
That's the spirit. But AA is very, very solid. AA
Probably
is very, very
compared to
solid.
the rest of the county, we're probably at the top. We're Wilson and Twin Valley.
I don't know what their ratings are, but
Plus
I might have been a
AA
little.
minus,
Yeah, AA minus.
So you're not ahead of them, and YO is probably right there, AA minus.
Yeah.
So you're doing pretty well. Maybe, I'm gonna say AA or better, maybe up to the 500, I might be a little bit aggressive.
Yeah.
So we can't get any higher.
You can get higher. You can go to AA. You can get rated AAA, but there's not a lot of AAA. I think there's only Lower Merion's rated
How do
AAA.
you get to be there?
I gotta stash more money.
Stash a lot more money away. You need to have big reserves and fund balance. And a lot of things that you can, the economics and demographics of the community play into it as well. But fund balance is one thing that they really look at. They want to know you have a lot of money.
I got my tax bill, we all have a lot of money.
But
We don't have
that's
to
all.
pay
Are we
it.
caring about what the state of the law? So I thought so we couldn't carry it.
There's ways some of the more wealthier school districts are doing it. They just designate more to capital projects and other funds. The 8% is subject to being unreserved, undesignated, so they get around it by just designating more millions of dollars into other funds.
You know what, AAA, I know that there's Lower Merion, Trinity East Town, downtown, Wissahickon, AAA. That's all I know. Not a lot.
Well, the east of us.
All the big industry.
LA's from crowd, everybody's getting.
Okay, so moving forward,
Well, what we're asking is that the Finance Committee allow us to put a parameters resolution together for the August board meeting. That will, we think, allow the market to stabilize, but then also give us the option at any time after that August meeting to pull the trigger on this first issue of $30 million to hit the market when it's ready for our bonds to be marketed. And the reason we're not saying next week is because it's a little close, and we do have to publish some advertisements in the paper, and it might be a little too tight to do that. And I'd like to wait for the market to come back down, which Lauren guarantees me is going to happen.
Well, we gotta do a lot of stuff, get the rating confirmed, we gotta go through the rating agencies, get the OS done and stuff, so it's gonna take that, we couldn't hit the market next week anyway. But we don't wanna do anything until we have this discussion.
And Mrs. Darrow, you have a question?
He's gonna sound crazy, but would we save any more if we flip-flopped and borrowed the 25 million first and then the 30 million? Did you look at that?
We could certainly run those numbers if you would like.
I'm only one board member, sir.
The thing that would happen then is that I'd have to factor in, if I did 25 million, I'm going back, just so you know, I'm looking at page 3 of the draw schedule. If I did 25 million in 13 and the balance of 30 million in 14, I'd need to borrow that $30 million sooner.
Right.
Okay, so there'd be interest associated with that. And then the discussion becomes, do you want to borrow more in this interest rate environment, or do you want to borrow more in, when you don't know what the interest
Okay.
rates are going to be in
Okay.
14?
I just had to ask.
Yeah, so that was kind of what I thought. I thought 30 million, get David's money back, gives you about a year. After bids come in, you kind of know where you stand on contingencies, how much you're going to really need, and then we can fine tune the last amount. We could split it in half, I don't know, but we just thought 30 million was a good number.
Okay, are there questions about putting this on parameters resolution on the August 4th agenda to when we go with that? Okay, so I guess I'll give a show of hands for putting it on the agenda. Okay.
I'm sorry, we don't have anything approved yet. I can't see going to borrow this money. Everything we've been doing since this building project started is rush. I'm not going to borrow money until I know what's happening. Once you borrow it, it's yours.
And just to be clear, if you do parameters, it would be the board action to authorize the transaction, but we would still have to issue it later. You follow what I'm saying? And the only way we could issue it later is if we met the parameters of the parameter resolution, if that makes any sense. So that the interest rate's not higher than such and such, and things like that.
But what I'm saying, we didn't get a lot of approval, so we can do the project yet. So, I don't understand.
Yeah, so one of the questions that was asked in the earlier meeting was what if for some crazy reason, the project doesn't go through? So if you play this out and we borrow this money, and for whatever reason, the project doesn't go through, the high school, senior high project, we have 30 million we borrow. Can you talk to us about what
Sure.
would happen or what would happen?
Typically, the parameters resolution would specify that the money would be used for capital projects. We can ask your attorneys to write in those resolution that they would be expected to be used for the senior high school project, but it could be used for other capital projects. So if you decide this project doesn't what you want to do, or for some reason doesn't move forward, as you said, you could use it towards another project. Okay, when you borrow the money, you say that you reasonably expect that you're going to spend it within 3 years. So you can't sit on it for 5 years, for example. So if you decide this project's not going to move forward, but something else is going to move forward, and that occurs in the next 2 to 3 years, then you just use the money for that other project.
The reason I ask is, going back, this whole this whole thing started with the growth that we've experienced in the district and the continued expected growth based on everything that we gathered. We have 4 projects in the set aside with plan time. The senior high we're proceeding with. It's all about making sure we have adequate facilities for the students to accommodate the growth. So I guess very simply, if for some reason this project tanked, we have another project, be it an elementary school or renovate Colebrookdale. So what I'm hearing you say is these monies could be utilized for
just would have to probably move relatively swiftly on that. You couldn't, like I said, you can't sit on it for 5 years, you need to do that. The other thing you can do with money is you can pay it back, but keep in mind, when you get the money for the profit, you borrow the money, you're gonna have closing costs deducted, okay? And then you're gonna have made a promise to the bondholders, which is, this is very typical of the market, that the bonds are gonna be outstanding for 8 to 10 years. Figure that out. So you're on the hook not only for the 30 million, but the interest payments for the next 8 or 10 years, okay? So it's not like you just pay it right back and get rid of it right away. So it would probably be in your best interest, to the extent you have other projects, to reallocate it to them as opposed to, you can't just get a $30 million deposit and just say, oh, let's pay it back, because it's not just the principal, you have to pay interest for that period of time as well. So it's a serious matter.
Yeah, that's why I'm asking the question.
Yep, yep.
Okay. So we're putting it on the agenda for the August meeting.
August 20th.
I will get in touch with Jeff Soltanic's firm to get prepared papers, and we'll see how that goes. Will we do it?
Yes.
Thank you very much.
Have a nice evening.
Thank you.
Thank you.
Thank you very much.
Drive safe. Because you have all that knowledge.
What's that?
Drive safe because you have all that knowledge.
Okay, next on our agenda is Pennsylvania budget update.
Yes, in case you haven't heard, the state has a budget. It took them till 11 o'clock on, was it June 30th or Saturday, June 29th, to get it done, and the governor signed it on Sunday. So I handed out a PSBA presentation on the budget. A couple of PD marketing pieces in the back about fast facts about the education budget. The most important to us is that the budget passed on time and slightly more funding for K-12 than originally was discussed by the governor. The money they put into the budget for K-12 was mostly all in basic education funding. Again, they didn't go by any real impressive type of equation. They basically said, we're going to give every single school district that has ADMs $108 per ADM. And that's how we came up with our increase. So the increase on this first long page that I printed out, the basic ed subsidy, shows all the school districts in Berks County and Montgomery County. But it shows our budget. What I budgeted was $14,028,300 or $639. And what was actually approved in the budget was $14,079,414, an increase of $50,775 over previously published numbers. So that now creates a positive variance in our budget when we get the money. So the other slight increase, and I don't know if this was an error on their special education, but all the spreadsheets of the estimated special education funding showed that we're going to get $3,141,876. The number was actually published on July 2nd as $3,157,664. So that's an increase of $15,788. So we're looking at just about a little bit over $66,000 more than was included in the budget that we adopted on June 4th. So that is very good news. PSBA goes into a couple of other things that whenever they pass a budget, they also do a whole bunch of amendments to the Pennsylvania School Code. And this year was surprisingly light, only because there's the three big issues the governor talked about. One being transportation, which really doesn't affect us. It's just if you drive across Pennsylvania roads and bridges. But they never got to that initiative. They never got to the teacher pension issue. They just put that on hold, and now they're on summer recess, and they plan to discuss it when they come back in the fall.
That's an incorrect statement. It's not teacher pension. It's legislators and the teachers.
Is actually all state employees,
Yeah.
including legislators, right? And the third thing that indirectly affected us was that they didn't get to the privatization of the liquor and state stores, which would have meant that $1 billion that would have been realized one time and was going to be divvied among all 500 school districts over a period of 4 years. So we don't have to, worry about that, because again, they deferred that one to the fall also. And you can look through this, but the one thing I was really disappointed that they didn't address was the correction of the charter school funding. The double dipping of the pension, special education, all those issues, and it's very frustrating to see. We don't write a check to any of the charter schools. We were one of the first school districts when charter schools came out, and we took the stand that we were not going to fund them, but we're not going to write a check to charter schools. And so the state takes that money from us every month, and it really angers me every time I see hundreds and millions of dollars going to charter schools when I know that we can better educate our kids. So, this goes through a couple of the supplements that they installed this year in addition, and you can look at it any way you want, but and probably Drew can attest to some of these things, like the funding of the English language learners. It means that Allentown, Reading, York, Lancaster, and Lebanon, and I don't know, Drew, if you negotiated some of that money, but they're all going to split $14.6 million because of the population that they have to deal with. Then we have the extraordinary charter and cyber, and this is on page 3 of the presentation. The bottom slide, the extraordinary charter and cyber school enrollment supplement. York City and Midland Borough are going to get $4 million. The increasing aid ratio supplement is going to Upper Darby. They get an additional $2.5 million. The small school district supplement goes to Penns Valley area, $500,000. So I don't know if these are special interests, but those folks got additional money other than the $108 per ADM.
You mean in terms of the charter schools for those districts?
Yes.
Yeah, well, York City had planned on going 100% charter school. And then through the Recovery Act. And because they didn't, they had a lot of interest in charter schools that cropped up all over York County. So they had to appease them in some way.
Sure.
And so therefore, I'm sure that's, some of that came out of this recovery fund.
Sure, and I'm sure they put the money in there to get the necessary votes to get the budget through. But you can see the other, the personal income supplements, second class A county school district, third class county school districts. So they're picking out some of the more interesting school districts to get money to. Then you get into page 5, certain things that they were eliminating physical exams for teacher certifications. That was a big issue that PSBA spent some time on. They do allow school districts to reopen the budget for 30 days since the budget is passed. I've only heard of one that's going to be opening it, that's Allentown, recently, and they're opening it to reduce their tax rate. So apparently their tax bills are not out, and they can catch them and lower the rate before they get published. There are some mandates for the Philadelphia School District, and given their financial issues, but really, overall, as compared to the last few years, the school code was pretty much not affected as much as previous years. So I did want you to have this along with the fast facts at the end, just so you know what's happening with the Commonwealth's budget and how they're funding education. And again, I was a little disappointed that they are not properly funding the school construction. There's $296 million in there, and it sounds like a lot of money, but when you split that between 500 school districts and all the school buildings in those districts, it's not a lot. And I hope Governor Corbett comes to his senses and realizes that this is supposed to be a partnership because we are a state.
Right, Mrs. Taylor?
I see this one school, well, 3 schools got for growth. If your district expands in size, do they give you special money?
Well, there was really no detailed explanation how they came up with these particular schools and why
Because
they.
we're supposed to be growing by leaps and bounds, so my question is, why are we doing
We probably didn't yell loud enough.
I don't think we're grown by leaps and bounds, but I just wondered what criteria
Well,
they use.
well, the interesting thing that I would like to point out on the long sheet, the basic ed funding, I did hide a bunch of columns because this would go about 3 pages in length on legal. The student-focused funding supplement is that $108 per ADM. And you can see that the 12-13 adjusted school district ADM for us is $7,156, as compared to the 11-12 adjusted school district ADM of $7,113. So it does show that we increased 43 ADMs this year, but then the next column over shows you how many charter school ADMs we had for the school district, and that's another 176. So I thought that those were pretty interesting numbers to leave on here, especially in comparison to the other school districts in Berks and Montgomery County, just to see, because I know Mr. Nichols asked how much do we spend per student. This will actually help you to determine that by the ADMs of each of those categories. And then you can see our preliminary aid ratio for 13-14 is at 4.765, up slightly from our 4.658 from the year before. And then the equalized mills is always something I like to show, because that takes our aid ratio divided by our tax millage and equalizes it between all the school districts throughout the state. And you can see our equalized mills are 17.2, and as much as I show you the where we stand on the real mills, and Reading's the lowest below us. If you look at Reading, their equalized mills are 19.7. So if you look at equalized mills, this is an 11-12 number, but we are the lowest. And you can see down in Montgomery that even with equalized mills, we hold our own, with the exception of the Wissahickons, which are AAAs, and the Lower Marions, which are AAAs. Because you can see what their equalized mills are: 12.6, 14.5, and 12.2 is Colonial. So those are fairly wealthy districts in Montgomery County. So I think we're doing very well as far as our equalized mills, especially when you compare that with our aid ratio compared to those other school districts. So, but it's good information to look at, and that's all available on the PDE website.
Well, I had a question, because of all the press that's out there about how much out there of record education investment, all this kind of stuff. So you read one party, it says this, and another party says that. So I guess I would like to see really what the state has contributed to us. If we could just run a little slip there to show us how much really we've been losing in funding.
Well,
In that,
I think if I show this on my five-year
plan.
projection, you can see it jumps right from column B to column F. So if I highlight those and unhide the columns I have hidden, we can look at that. Okay, so this goes back to 9-10 as the actual. Now, if you remember, looking at the items I have in orange, that's the school funding fiscal stabilization, the ARRA federal stimulus money. Those were actually the highest years that it appeared that we were getting money from the state. But the way the legislators basically sold it was that they were only putting in so much money, but we were using, the federal government's money to give it to states, to give it to school districts. So those years we had, 14.2 million and 14.8 million. But you can see what the state took credit for is 12.5, 12.1. And then we did get an increase in 11-12 of 13.7, but that reverted back to what we got in the 8-9 year, which isn't shown on the spreadsheet. And then it stayed that way for 2 years. So that there was about 4 years there, or 5 years, looking at these 8-9, 9-10 through 12-13, that we survived on $13.7 million. We didn't get any increase, even though we had increased costs. And it wasn't until this year that the governor or the legislators finally loosened their purse strings. and actually gave us a little bit more money, so now we're getting to 14,079,000. So, to their credit, they are right, it's probably the most they've ever given us, but if you compare it to those 2 years where they intercepted federal ARA money, it's not.
Right. And plus, it's not that much between 13, 12, 13,
Correct. It's only like 2.4%. Yeah, and that after 5 years of pretty stable funding, where we were incurring 3, 4, 5%, including teachers' increases. And now they're saying they're very generous by giving them 2.4%. Now, we're appreciative of anything they can give us, but really look at reality, look at what all school districts have been surviving on for the last 5 years, and now justify a 2.4 after you haven't given us an increase in 5 years.
Right.
So if you netted out the Peasers increases, the numbers would decrease?
Yeah, we were in a hole, which is exactly why all school districts have had to raise their taxes.
Exactly.
Right.
Because the state has not been funding us properly. And I talked about this at the last finance committee about the elimination of school taxes. My proposal would be to go back to where they were in 1985, where they agreed to fund 50% of the school district operations. We would be able to cut our 23 mills down to around 11 or 12. That's real relief, and it still gives us a little bit of control. But the state would have to do something and raise their taxes, which they haven't done in many, many, many years.
So all they're doing is reaching the other pocket.
It's a trickle-down effect, and 500 school districts are stuck holding the bag.
Mr. O'Seer?
2 questions, Dave, and I know this isn't your presentation, but it's tough to read. The page 6, safe school appropriation, the Senate bill. What is that? It's really tough to read, but do you have any idea what that's saying?
Well, what they're trying to do is, with the shooting in Connecticut,
Right,
the
that's
shooting
kinda
in
what-
Ohio, what they're trying to do is they're trying to help school districts create better security. This is money that's set aside for school districts to hire retired police officers. Now, we already have one. We have Rafe, we have Mr. Miller at the high school, and but this would be to help school districts that can't afford those school resource officers.
So this doesn't affect us?
No. Unless we wanted to hire another police officer, but the problem is, how long is this funding gonna go on? It's this year, it's like when they say, oh, we're gonna fund 100,000 cops, but next year you don't get any money, now you got 100,000 cops that now you gotta pay. Yeah.
And then a second question, so it sounds like we have $65,000 more than we thought. What would be the recommendation from the cabinet? It's probably too early, but what would we do with that money?
Well, I mean, 65,000 relative to a $97 million budget is not a large amount. What I would, we have a very tight control on our expenditures. We don't plan on overspending our expenditures. We hope that our revenues come in at 100%. So that will create a better than expected fund balance. If you remember, we have currently $750,000 of use of our committed fund balance. What I would say is use $65,000 less of that $750, so that we have it in future years, which we'll get into as we look at our 5-year projection. We're going to need it.
So in essence, save it,
Yes.
so to speak, on the committed fund balance.
Okay. Any other questions about the state budget update? Next, we're going into district transportation van bill.
Yes. For the last few years, we've been budgeting a replacement of our student vans. The vans are used, are 9-passenger vans. They come with a custom seat arrangement where there's an aisle down the middle. And these are used to carry our field trips, our TSA winners, our FBLA winners, our music department, up to 9 students to faraway places, Pittsburgh. I say that only because Drew's here. And we're a little concerned that of the age of our current fleet. And We've put it off for a number of years now, and we believe that this is the year to do it because more and more maintenance is required for our vans, especially the 1998 van that we're proposing to hand down to our courier and get rid of his 1980 or 1991 or something like that.
I like that one.
With the orange
Car
door.
doors.
2 different car doors, and you can follow the smoke for about a block after he's visited your house to drop your packet off. So that is the one that we're ultimately going to be retiring. And the 98 that is suspect for any long trips will be delegated to our courier. And then we will use this new van to transport our kids and give us a little peace of mind knowing that they're safe and in something a little bit more current than a 1998 or 2003 van.
Okay, anyone to put this on the agenda?
Correct.
Okay. Is there any questions or comments or opposition to putting it on the, Mrs. Simmons?
The estimated cost.
We have budgeted 30,000.
Are you gonna specify the brand in our, whatever it's called that we do? Our cars
In the
are
bid
two-
spec, yes.
Our cars are 2 or 3. What are you making fun of that for?
Well, and I drive a 2000, but it's not a 1998, and I'm not carrying our precious cargo, you know.
So you're gonna specify a brand of vehicle?
Well, we like Chevys, but we will entertain anybody that wants to bid. That's what most of our vans are, so.
Kind of what should be,
from the board. Chevy.
it'd be putting.
We'll be leaving anyway,
It's
November,
bids
you're
for
not, so
nine.
it don't matter.
Hey.
Yeah, it'll be a 9-passenger, but we'll spec the specs
Yeah.
for a Chevy, but we'll allow alternates, Ford, Dodges.
Oh,
I
good.
think we should.
I like that F-word.
Yeah.
When? Goodness sakes, we have company here.
I know kids are in the audience.
So
Okay.
it is a budgeted expense, I just asked if the finance committee would
So-
support that.
We
So
aren't
show of hands if
replacing the
it's-
van, we're replacing the courier's vehicle.
Correct.
Right, so I mean,
We're adding to our fleet.
what?
Well, no, we're gonna eliminate
Yes,
the
yes,
local.
yes.
Yeah, so it's, we're buying a van, but we're not gaining a van.
Right.
I'd be in
What do
favor
you
of
do
putting on
with
the agenda.
the old one, the one that you were gonna retire?
We can try to sell it. We have sold some of our old vehicles, and I know, Pat gets some of the bids, but I think the last one we sold, one of our trucks that was really rusted out, we got $50 for. We were real happy for that. But the last one we got, I think it was about $1,200, so we were really happy that somebody bid and we gave it to them, so. So we will not just give it away, but somebody's out there will drive it.
Okay, show of hands to put it on the agenda.
Would
Okay.
you use it as a trade-in?
That's a possibility, but have you seen that van lately?
No, I haven't
I have, I think it's nice.
I'll be expecting an offer.
If it was that nice, I already have a car.